BlackRock is the largest hedge fund in the entire world at over $10 trillion of assets under management. That's trillion with a T, or close to half the entire GDP of the United States. I mean, it's just crazy to think about. Well, it just so happens that they went on a shopping spree last quarter, picking up several different stocks worth billions of dollars, and that report just got released for all the public to see. So in today's video, we're going to take a closer look at the top 5 largest stock purchases that BlackRock just made, which, by the way, includes two stocks that I have never even covered before on the channel ever, and one of them is a brand new addition to BlackRock's portfolio worth billions of dollars. So it's going to be a lot of fun to take a look at these stocks. I'll of course give you my quick opinion on every single one of these, and I'll even rank them from best to worst based on my own opinion as well, like we always do it. It's always a ton of fun. I can't wait to jump into this. By the way, thank you for all the support. If you want to support the channel, all you got to do, hit that like button, subscribe. If you want to go above and beyond, really help keep my channel alive, please consider supporting me on Patreon, where you also get access to our channel's exclusive Discord, and we can talk about stocks on there together all the time, every day. So it's a lot of fun if you want to consider that. But anyway, thank you for all the support regardless. And with that said, let's take a look at what stocks BlackRock is buying. It's going to be a lot of fun. Let's jump into it. All right, now we'll be counting down here from smallest to largest in the portfolio. And stock number 5 is actually a brand new addition to BlackRock's portfolio and is already worth billions of dollars. And that is GE Healthcare, ticker symbol GEHC, which they purchased almost 27 million shares of at over $2 billion. And yet, despite that, being so much, it's only worth 0.06% of the portfolio. How crazy is that? Just shows you how big they are. Anyway, GE Healthcare was actually spun off from General Electric back in January of this year. So it looks like BlackRock took the opportunity to pick up some shares right away of the newly formed stock. And so far, it is looking like a pretty good bet by them, as the stock has already climbed by almost 40% so far this year after IPOing. Business-wise, it's also looking pretty attractive since it was originally spun off for being a higher growth segment than the rest of the company, and so now it can focus just solely on its own growth and its own future ambitions. Case in point, every one of their 4 different segments grew sales by double digits last quarter, with imaging rising 12%, ultrasound rising 10%, patient care solutions rising 11%, and pharmaceutical diagnostics another 19%. Very good growth in that particular segment as well. Mind you, this is also during a trash economy with even some supply chain issues still lingering post-pandemic, but GE has done a great job keeping up with demand for both their technology and hardware products, as well as the services for operating and maintaining those systems, which makes up about 1/3 of the company's size. That's pretty good. Unfortunately, though, guidance is looking pretty weak right now, with overall revenue growth only expected to be in the single digits this year, which is even less than what they saw the year prior. So that tells me that they might be expecting a slowdown soon throughout the rest of the year, as their EPS growth is also at risk of falling into the single digits as well. So considering they already trade for a PE ratio well above 20, I just don't think the stock is very cheap or any kind of amazing value right now. I mean, I do like the business, and they did just announce a new dividend as well, but it's super tiny at just 0.15%, and overall, I just think you'll find better deals out there in the market for anything that you're looking for here, whether it's growth or value or the dividend. So I'll put them right around the middle for now at number 3, since I still need to see what else is on this list here before I give it a more definitive ranking up or down. Moving on though to stock number 2, we've got the global industrial gases and engineering company, Lind PLC, ticker symbol LIN, which BlackRock grew their position on by almost 9% last quarter, adding close to 3 million more shares, bringing their total stake in the company up to over $12 billion. And even that is still worth just only 0.36% of the overall portfolio. So it's kind of crazy. Anyway, Linde is actually a very well-known company that produces and provides gases for all sorts of industries like manufacturing, electric technology, energy, and even healthcare and more. In fact, they're even a big player in hydrogen and other renewable energies, as well as the building of semiconductor chips and a lot more. There's just a ton of different applications that they're used for, and these are all areas that will always really need their products and services, especially in a booming industrial economy, which of course right now the macro economy is very weak, and Linde has even suffered major setbacks in Europe because of the Russia-Ukraine conflict. But yet despite that, you can still see just how resilient their business is, with growing sales and profits that reached a new record high last year. Granted, sales are now slowing down to a mid to low single-digit percent growth, but this isn't really much of a growth-oriented company anyway. And even if it were treated as such, I mean, they're still growing EPS by over 10% expected over the next 5 years, which is coming off of already very high growth of 17% in the previous 5. And so the result is just as strong and dependable of a stock that you would expect, which unfortunately for anyone not yet invested in the stock like myself, it's now trading near a record high, with a pretty rich valuation of over 100% more expensive than the sector on a PE ratio basis, and still over 36% higher on a more forgiving PEG ratio basis, and that's even with that very high EPS growth. And while they do pay a nice little dividend of about 1.5%, I just don't think it's anywhere close enough to making up for that rich valuation. I love the company and I love the business, but as a long-term investor, I'm looking for more upside potential on the stock price, so I'm actually going to rank them behind GE Health at number 4, since I feel GE is cheaper and has more of that upside potential that I'd be looking for long term. If you want to see a stock that I think is an absolute no-brainer pickup though, then look no further than stock number 3, which is a stock that I am heavily investing in myself too, and that is the great and powerful Amazon, ticker symbol AMZN, which, no big deal here, BlackRock just increased their position by a measly, little 2%. But that's still close to 13 million more shares, bringing their position in the stock up to almost $63 billion, and yet it's still only worth less than 2% of the portfolio. It's just so crazy. Anyway, like I said, guys, Amazon is a no-brainer here, and I love this pickup. You're talking about not only the world leader in e-commerce, but also in cloud computing, which is just as important, if not more important. They've already taken the 3rd most market share in digital advertising, only behind Google and Meta. They have a big stake in Rivian and already use electric vehicles for their own logistics fleet. And they have just about as many video streaming customer subscribers as Netflix and Disney through their Prime subscriptions, which also includes music streaming as well. And there's just no telling what other markets Amazon will tap into next. I mean, for example, they're already embracing the recent trend of large language models like the ones used by ChatGPT by integrating their own version into their new Alexa devices. The result of Amazon's already large dominance, though, is that they do an insane amount of sales at over $500 billion per year and are still somehow managing to grow at around a double-digit percent. But because Amazon isn't focused on profitability yet, even losing a few billion last year, investors are selling out of the stock in droves and causing it to crash by almost 40%. Long term though, I think that's a mistake. Amazon gets the number 1 spot here. It's a no-brainer pickup on such a large dip like this. There's actually a stock here though that might be threatening Amazon's rank. At stock number 4, we've got the almighty Microsoft, ticker symbol MSFT, at close to 5% of the portfolio after having added another 5+ million more shares, bringing their total stake in the company up to over $150 billion. And yeah, this one is definitely going to give Amazon a run for its money. Now, Microsoft, course, is one of the best run companies in the entire world, if not the best, with consistently giant financials on both the top and bottom line, doing over 70 billion of just net income alone last year, and they're still managing to grow at around a double-digit rate on the top line and over 12% on average expected over the next 5 years on the bottom line too. And that's after also putting up huge growth in the previous 5 years as well. Now, mind you, this is during probably one of the worst kind of economic conditions for Microsoft that you could imagine, where the PC market is completely deteriorating because of us coming out of the pandemic, where demand is now in the gutter, the economy is trash, and PC shipments worldwide are down 30%. But not only has Microsoft proven resilient, even in this horrible environment with the second most cloud market share and the number one PC operating system and productivity software market share, but they're also finding new ways to fuel growth, especially from artificial intelligence, where their investments into ChatGPT have not only made it the fastest growing app in history, but because Microsoft is now able to implement it into various parts of their own business, it's also helped them finally grow their Bing search engine business, which actually caused Bing ads revenue to climb by a double-digit rate last quarter, while Google was actually flat because of that really weak environment, and there's a lot of weakness in advertising markets right now as well. Plus, Microsoft also has huge potential in becoming the Netflix version of gaming with Xbox Game Pass, which, by the way, their acquisition of Activision Blizzard looks like it's finally getting back on track, with regulators starting to pass approvals after having gone back and forth on it a bit. But now we saw European Commission, we just saw China as well. And if this really gets approved in the end, I mean, Microsoft is just going to be an even bigger gaming giant than they already are. And so when ranking it on today's list, I would actually say that Microsoft is the better all-around stock when compared to Amazon. However, Amazon stock is currently down a lot right now, while Microsoft is trading still kind of near a record high. And while their valuation is very similar based on profits from a PEG ratio basis, Amazon is actually significantly cheaper when based on sales, which again, it's just because Amazon doesn't really care about profits yet, since that'll really come later on over the longer term. So I hate to do it, guys, because Microsoft is my own number one largest stock in my own portfolio, and they even pay a nice little growth-oriented dividend, but I'm actually going to keep Amazon ahead of them at number one, just because I feel that it's slightly, very slightly more attractive at today's specific prices. But Microsoft goes right up there, right next to them, neck and neck at that number two spot, just barely behind Amazon. Well, damn, just when I thought that we had the two best stocks in the entire market on here, we're left with yet another contender for that number one spot. And that's going to be at the final stock here, that's going to be the largest stock in the entire world by market cap in Apple, ticker symbol AAPL, which BlackRock bought another close to 6 million more shares of, bringing their total stake in the company up to over $170 billion at over 5% of the portfolio. And I believe this is their largest stock in their entire portfolio as well. And yeah, another one here that I don't really think you can go wrong with. I mean, there's a reason why it's the most popular stock in the world, right? And I actually own a small position in it too myself, in large part because of their gigantic size and dominance, doing crazy financials, around 400 billion in sales, with 100 billion of it going straight to the bottom line. It's so crazy. And guys, when we talk about Amazon not being profitable and how big Microsoft is in comparison with profits, but Apple is just on a whole nother level here. 100 billion in profits per year. Are you kidding me? How the heck are they doing that as primarily a smartphone seller? Well, it's because they've built up an incredibly sticky and resilient ecosystem of other products and services all around their flagship iPhones, including earbuds, watches, tablets, and of course all the services that run on them, which is where they get their higher profit margins from too. But you would think that at that size, popularity for the iPhone would dwindle away, but in fact, iPhone sales last quarter were actually better than expected by analysts and still managed to grow year over year despite the horrible economy, the supply chain issues, and most importantly, the broader smartphone market, which has actually seen a gigantic decline of almost 15%. That's pretty crazy that iPhones are still able to sell in this kind of environment. And just imagine how many more they can sell and how many more people will choose to upgrade their iPhones when Apple starts releasing foldable versions. I think that might be the next kind of upgrade super cycle for the iPhone. But in the meantime, like I said, Apple is extremely profitable, which is why they have such a gargantuous balance sheet of well over $100 billion of just current assets alone, which they'll not only tap into when needed to launch new products and services that help them stay on top and grow, but it's also how they managed to buy back so much stock at over $500 billion of buybacks in the past decade. And they also pay a small dividend with some future growth potential on it too. The only reason why I've decided to not buy any more shares myself, though, it's just a small position of mine, I'm not looking to make it any bigger, is because I just think that there's more attractive options out there in the market right now. Of course, the economy is pretty bad, and Apple's business tends to be very cyclical during times like this, which is why their sales are actually expected to decline this year before returning to growth. And yet the stock is still trading near an all-time high with more than a 20% premium to the sector on a GAAP PE ratio basis. So I just think Amazon and even Microsoft are better options. Nothing against Apple, but they're just not going to be dethroning either one of those today. So there you have it, guys. I'm keeping Amazon at the #1 spot, with Microsoft just barely right behind them at #2. Then I've got Apple coming in as the clear choice for #3, with GE Healthcare and Lin PLC being moved down one spot to the #4 and #5 spots, which, by the way, nothing bad about those stocks either. It's just that on this particular list, they're just completely overshadowed by three of really the best stocks that are out there in the entire market. So yeah, overall, I like these pickups here by BlackRock a lot. Not a huge fan of the bottom two, but definitely a fan of the top three. Can't go wrong with those in my opinion. But what do you guys think? Do you like these stocks? Are you investing in any of these? Do you agree with these? And are there any other hedge funds, famous investors you want me to take a look at in future videos? Let me know. Thank you for all the support, everyone. Thank you for being so awesome. I love and appreciate all of you. I will catch you in the next video, my friends. I hope you're all doing well. Take care. Bye-bye.